Hello, good morning, viewer. Welcome back to my video and my channel, Ho Can Talk Again. Thank you very much for returning to my video. And today's video is regarding a question that has been asked um, by many of my friends. So I think I would do a short video on today's topic. Today's topic is what happened to the New Zealand dollar. Okay, and again, I hope that all the viewer can subscribe to my video, which will be presented in both languages, Chinese and English. And again, the normal presentation style will be marker and paper. So without further ado, I'm going to zoom in into this video. Today you see, I put on a shirt. Well, anyway, because it's very hot now in Singapore, I actually changed to this shirt because the t-shirt is soaking wet. Now, again, the New Zealand dollar has always been a high yielding interest generating dollar. Many Singaporean older generation were being affected by the New Zealand dollar because 30, 40 years ago, a lot of Singapore or a lot of international investors actually convert their hard-earned saving from local currency, which is in this case Singapore dollar, into New Zealand dollar just to earn the high interest rate. At that time, the interest rate sometimes it go up to 11%, 12% per year. So a lot of the saving population, a lot of the people in Singapore actually convert their lifetime saving from Singapore to New Zealand dollar in order to earn a high yield. Now, but what happened to New Zealand dollar throughout the years since 1990s all the way until today? US dollar has more or less I shouldn't say depreciated because of economic issue, but because the interest rate of New Zealand dollar has shifted from high yielding to low yielding, which resulted in New Zealand dollar trading more within acceptable level against other currency. So today's video will be very much on the reason why they need to give out such a high interest rate and why the interest rate environment has been changed, and a little bit touch on the overview of the New Zealand economy and what happened, why so many people are leaving, and what happened to the challenges faces by the New Zealand economy. Okay, now without further ado, let's go through the first slide. So what happened to New Zealand dollar? Now, I show you a FX chart, the foreign exchange rate. I didn't show you a graphic, but I'll use table so that you can immediately see the contrasting effect. Now, New Zealand dollar past and now compared to renminbi, US dollar, Sing dollar. Now, before 2009 is 6 renminbi against 1 New Zealand dollar. 0.8 US against 1 New Zealand dollar and 1.2 Sing dollar against 1 New Zealand dollar. But now it more or less dropped. So New Zealand dollar vis-a-vis renminbi, US dollar and Sing dollar has all fallen. For the renminbi is 4, US dollar is 0.6 and Sing dollar is 0.75. So for those people who convert from Sing to New Zealand actually suffer both sides in the sense that they suffer on the FX, they also suffer from the interest rate which drop from a high double digit or even high single digit such as 8%, 9% to a current low level interest rate. But again, the drop in interest rate is very much in line with global development, especially after the financial crisis in the year 2008. Now, New Zealand dollar went through a structural reform from last time high yielding to currently low and balanced yielding. Now, like I mentioned, in the 1990s, the interest rate paid by New Zealand dollar is very high, but now it more or less come down and it behave like more like other developed country currency with a balanced interest rate with more in line with global trend. So actually, New Zealand dollar went through a structural transformation, which see their interest rate being reduced to the current level. Um, this is the key thing, and I must say that the New Zealand dollar weakened against the previous three currency, renminbi, US dollar, and Sing dollar. Is not so much of an economic related, but very much on interest rate related. The interest rate dropped, that's why the currency also moved downwards. But economy does show some weaknesses, but again, it's not big enough to create such a big swing. Now, why there's a high yield? Why last time in the 1990s, New Zealand uh, government or the Central Bank of New Zealand willing to pay high interest to the currency? Why? Okay, at that time, before 1990s, there was high inflation. There was high inflation, and because at that time a lot of countries pegged their currency to the US dollar. Now, in this case, New Zealand is very close to Great Britain, so they actually pegged the currency to pound, and pound is directly pegged to US dollar. And because of that, you lose flexibility in terms of FX movement. So, and at that time, because of the crisis and whatsoever, New Zealand government is very aggressive in promoting the local economy to stimulate growth, and that's the reason why at that time, in order to bring in more capital inflow, they actually increase the interest rate to attract more capital inflow. But the main thing for interest rate to keep high was to combat inflation. But at the same time, they also wanted to use loose monetary policy to bring in more economic activities. So there are usually two methods to do it. Either you control your FX rate or you control the interest rate. So in this case, the choice was the interest rate. And also, of course, because at that time, there was an oil crisis in 1973 and 1979. So that bring a lot of inflation into many countries such as New Zealand, which is a net importer of energy. So, and because of that, they need high interest rate because the currency is pegged, and after the depeg, the influence is still there, so they need high interest rate to combat inflation. And also, there are other micro or internal factor also regarding why the interest has been kept high, or sorry, why the inflation is high. One of the factors is because they have a strong union. Now, New Zealand is being ranked number one in terms of work-life balance. So to make sure that all the employee there enjoy very good work-life balance, they have very strong union backing. And this union actually demanding year after year of wages increase above the productivity increases. So there are price and wages increase, spiraling effect in New Zealand, which further add on to the inflation. And number two, government was very actively intervening in the market. They control the pricing, they control the import. There's a lot of intervention, so which make that the whole economy is not really 100% reflective of the market movement, and because of that, inflation is very high. Um, the third one, which is the most important factor, will be the geographical isolation. New Zealand is far away from many business centers, many business hubs. So the transportation logistic cost, if you want to bring a lot of things to New Zealand, is always higher than the rest. That's the reason why it also contribute to the inflation rate in New Zealand during that time. And because of the location disadvantage, New Zealand economy is heavily dependent on agriculture, which is commodity linked. So during that time when the China economy is doing well, commodity prices is going up. It also bring in inflation into the small and far away open economy. So that's why during that time the inflation is high, and government, Central Bank of New Zealand, Reserve Bank of New Zealand use interest rate to combat inflation. So they up the interest rate. Now, but what happened with all these things? Because uh, when they start to use interest rate, because at that time, and before they can use interest rate to combat the high inflation, in 1989 there was a reform. Okay, sorry, just now I just want to recap on all the slide here, that why high yield, meaning that why the interest rate was so high, because the inflation was very high in New Zealand, and the main reason for giving a high interest rate to the currency is to combat inflation. And I name a few of the factors that contribute to high inflation. And in which year did the Reserve Bank of New Zealand was able to use interest rate to combat inflation? And it was in the year of 1989. There was a reform, and that reform resulted in the passing of a bill called the Reserve Bank Act 1989. This gives more power to the central bank of New Zealand, which is a Reserve Bank of New Zealand and Central Bank of New Zealand at that time, after 1989, since they have more power, they are independent from government intervention and all this, so they have decided to use high interest rate to fight inflation, which was due to all the factors that I mentioned in my previous two slides. So you can see that after 1989, the Central Bank of New Zealand, Reserve Bank of New Zealand, was given more power to act on their own to fight the inflation. So at that time, they chose using high interest rate. Now, a very interesting comparison at that time in the 1989 or early 90s, I actually wanted to compare their strategy against two other countries who are all facing inflation at that time after the oil crisis and all these things, and how they do it differently, which resulted in there is a structural change in the New Zealand monetary reform from high interest rate to low interest rate. Now the two countries that I chose is Singapore and China. Now I actually put on this slide here. Now Singapore, China and New Zealand all facing all this import fluctuation, because like Singapore, we are also an open and small economy. Likewise for New Zealand, China was developing then, so there are a lot of industry are vulnerable. So these three countries actually adopt different kind of monetary policy and a fiscal policy to maintain stability within the local economy, or which is inflation or any price surge that will outflow or inflow from outside that will affect the local economy. Now, we have been talking about New Zealand. So New Zealand choose a free floating of FX, but instead focus on interest rate over FX. So meaning that they rather allow the FX rate to fluctuate, to move freely according to market, but they want to control the interest rate so that to fight the inflation. Now for Singapore, what is the strategy of Singapore, which is almost totally opposite? Singapore actually use FX rate to fight inflation, to fight import price increase, but rely less on interest rate. So that means you either control the FX to control overseas price hike or the price influences on the local economy through in a form of inflation, or you use interest rate. But in this case, Singapore preferred to control the FX. They do not allow the FX rate to fluctuate freely, and the FX rate up to today, Singapore is managed by MAS, our central bank, that they were linked to a basket of currency to make sure that Sing dollar remain competitive and remain conducive to the economy of Singapore to help them to export, because we are open economy, we are heavily dependent on trades. Now for China, they actually use a hybrid system. Same, they actually control the FX through a peg, but they, in addition to that, because they're a huge economy, and also the size of the economy is different from New Zealand and Singapore, and also at that time they are developing, so they implement capital control, or what currency control, meaning that any inflow or outflow of money, you need the approval of the central bank. So in this case, they more or less isolate themselves from all the high price fluctuation from outside into China. So China use a hybrid system. New Zealand use a free market system, let the FX fluctuate, but they control the interest rate domestically. That's the reason why it resulted in such a high yield, or the interest rate dropped significantly after they go full market forces, full market driven. But in Singapore, because we choose to manage our FX to make sure there's a FX stability, but we actually let the interest rate link follow to the global environment. So these are the three different approach used by three different countries. Now, what happened to the high interest rate for New Zealand dollar? Why it dropped to the current level, which is in line with a lot of international developed country currency? The interest rate is more is 1 or 2% currently. Now, there are a few factors. The biggest factors, of course, is the global financial crisis in the year 2008. This resulted in a huge downward revision of interest rate globally, and because New Zealand is also a open economy, and they have to follow the trend, because at that time there's no choice. If not if there's any disparity between the interest rate, that will cause some difficulty in managing the local economy. So the whole globally, the interest rate is going down, and that's the reason why New Zealand dollar emerged from a high yielding currency because central bank wanted to fight inflation to a interest rate or to a currency that offer interest rate in line with the global situation because everybody is reducing interest rate now. And also this one will be a later factor because New Zealand is very much dependent on tourism. And so after the COVID-19, the tourism interest also dropped. Tourism inflow also dropped to New Zealand, and that's the reason why New Zealand government got to ease the interest rate to promote the local economy. But again, the biggest factor will be the over reliance on New Zealand on China at that time. So when China slowed down in the last 10 years, 5 years, especially commodity related slowdown, the demand for agriculture product and all these things dropped because of drop in consumption. So basically, when there's a slowdown in China, it affects New Zealand badly because I think 20 to 30% of New Zealand import and export are linked to China. So because of that, and also in line with the global situation, the interest rate of New Zealand of New Zealand economy start to be more in line with the global environment. This is also to stimulate growth. Now, there is always a comparison between Australian dollar and New Zealand dollar because these two countries are always linked together. So I must say that Australian dollar is more stable. The interest rate movement is more stable compared to New Zealand, which is more drastic, and the reason why. But bear in mind, both of these countries depend very heavily on China for export especially. But for Australian market, I put down here, the commodity export to China is more balanced. They have industrial export, which is iron ore, aluminium, bauxite, all kind of mining materials. They also have agri, so their export to China is more balanced. But New Zealand is very much agriculture only. They don't really have a big industrial mining industry. So for New Zealand, it's more narrowly focused. That's why they are more volatile. When China slow down, then they will be affected more. Now, Australia also have a bigger economy, so they can actually cushion, they have more buffer to cushion any slowdown in China. But for New Zealand, they have a very weak local economy, a very narrowly focused economy, focused on agriculture and tourism. And so when China slowed down, they actually been affected much more than Australia. And the last factors is Australia economy is more diversified, which I mentioned. They have more thing, they offer more thing than New Zealand. But New Zealand suffer from another additional thing is too far away from the central of activities, too far away. That resulted in high logistic costs and whatsoever. So again, the last few slides, I actually explained to everybody that why New Zealand government adopt a high interest rate, which is to combat inflation at that time, and also after the 1989 banking reform, which allowed the Reserve Bank of New Zealand to use high interest rate to combat the inflation. But later on, coming to 2008, after the financial crisis, globally there's a huge trend moving to reduce the interest rate, and also US dollar become gain in dominance again. So New Zealand dollar, the interest rate offered by New Zealand dollar has also to adjust downwards to be more in line with the global environment. So that is the main reason why the yield of New Zealand dollar reduced. It's more in line with the global movement rather than a huge deterioration of the economy. The answer is no. So, but again, there are external factors that affect New Zealand, like such as the geographic location, which is quite far away, and also the economy is very narrowly focused, and also they have strong local union and all these things to create imbalance between the prices and as in the wages and other which is affecting the productivity and whatsoever. But again, this video I'm not going to go in deeper on this economic analysis of New Zealand. I just wanted to let my viewer know that last time New Zealand offered high interest rate. Why? Inflation. Now, why it come down? Because of global financial crisis, because the interest rate is more or less now in line with the global situation, rather than at that time, Reserve Bank of New Zealand is very aggressive to fight interest rate using high high inflation using high interest rate. I also compare Singapore, China, and New Zealand, and the difference between how they manage all these things, which is quite different, and which resulted in the resulting situation in Singapore, China, and New Zealand. Now, the last few slides I'm going to just quickly run through, because this give an overview of the New Zealand economy. Like if you look at the GDP, quite sizable, about 200 over billion, but you can see that the growth is not very consistent, and you can see that basically New Zealand economy more or less has stayed stagnant for the last few years. And if you look at the reserve and the FDI, foreign direct investment, is quite low on both aspects. The reserve is also very low. The FDI is also very low, because again, the main reason for low FDI is New Zealand is far away from all the major central activities, and the isolated location also make all the logistic and business operating costs much higher. So naturally, the FDI is not so high. Now, if you look at the last slide, I mentioned New Zealand and Australia is very much dependent on China. So if you look at the major trading partners of New Zealand, they actually export almost 30% to China and another 13% to Australia. And bear in mind, Australia also export a lot to China. So basically, New Zealand economy is very much linked to China economy performance. So from here you can see the rest of the country like USA, Japan, South Korea, they are big but not so significant. But even on the import side, New Zealand also heavily depend on China and Australia. So as you can see, a lot of people use New Zealand as a proxy to the China economy. And in this case, this gives you some snapshot about the structure of the New Zealand economy. And I hope you, with all this background information, you more or less understand the reason why New Zealand dollar transformed from a high yielding currency in the past to a low yielding currency currently. Okay, I hope all of you benefit something from my video. This video again is not going to touch on the economic performance of New Zealand, but very much to provide an answer why they offer high interest rate in the past and why the interest rate back to normal now. So I hope you like my video, and if you like my video, kindly subscribe and circulate my video to all your friends so that they can also subscribe and enjoy from the video. I need at least 1,000 subscribers. Okay, thank you very much. See you next video. Bye bye.